I spent 6 months analyzing 500 rental properties. All of them were labeled successful by their owners, shared proudly on BiggerPockets, YouTube, and Facebook groups. But here's the shocking truth. 73% were actually losing money when you factor in the real costs. Not breaking even, not cash flowing, but bleeding slowly, month after month, because of how the numbers were presented, not how the properties performed. So what's everyone getting wrong? Let's start with the fake success stories. You've seen the posts. Just closed on my first duplex. Cash flowing $500 a month. Already up $60,000 in equity. It sounds like a dream, but when you actually unpack the math, it quickly turns into a nightmare. Take this real example. Names blurred, of course. Investor buys a $320,000 single-family home in a Sunbelt city, puts 20% down. That's $64,000. They claim $2,400 in monthly rent and a $1,900 mortgage. So they say, I'm clearing $500 a month in cash flow. It's a win. But wait, what about vacancy, maintenance, capital expenditure, property management, annual insurance and tax hikes, turnover? None of that was included. So I ran the real numbers. Vacancy reserve, 7.5%, $180 per month. Maintenance, 10%, $240 per month. CapEx, $150 per month, insurance and taxes. Trending up 8 to 12% annually, and let's say they self-manage. But we'll assign just $100 per month to cover the value of their time. Their real monthly expenses? Closer to $2,570. Meaning that supposed $500 in cash flow? Gone, replaced by a $170 monthly loss. And this wasn't a one-off. It was the pattern in property after property. So what's getting missed? Here are the 7 hidden costs that kill cash flow, and why most beginner investors don't see them coming. First, maintenance. Everyone wants to budget 5%, but 10% is more realistic, especially with aging homes. Toilets break, water heaters leak, and driveways crack. Next, vacancy reserves. Landlords assume 100% occupancy forever, but tenants move. You need to factor in at least 7.5% of annual rent lost, just for turnover time. CapEx reserves, the most forgotten category of all. Roofs, HVAC systems, appliances, big stuff breaks, and when it does, it's a $5,000 to $15,000 hit. If you're not setting aside $100 to $200 a month for CapEx, you're walking a financial tightrope. Property management. Even if you're self-managing today, your time has value. What happens when you want to scale? Travel, or you get that 2 a.m. plumbing call? Then there's insurance. Premiums are rising fast. Across the country, we're seeing 8% to 12% annual increases. And if your area is disaster-prone, it's worse. Don't forget property tax reassessments. That $250,000 home you bought in the 2021 is now worth $320,000. And guess what? Your tax bill is going up with it. Finally, turnover. It's not just lost rent. It's cleaning, repairs, painting, and tenant placement fees. On average, a single turnover can cost $2,000 to $3,000, even higher in competitive markets. All of these costs are predictable, but most investors ignore them because they want the deal to look good on paper. Now let's look at 3 case studies. First, property A. It looks great on Zillow, asking $285,000. Rent is $2,100 a month. Mortgage? $1,600. On paper, it cash flows, but include real expenses. $2,100 gross rent minus 7.5% vacancy equals $1,942 minus 10% maintenance equals $1,732 minus $150. CapEx equals $1,582. Property management equals $150. Insurance plus tax equals $350. You're left with less than $1,100, and your mortgage is $1,600. You're losing $500 a month. Now, property B, labeled a cash flow king, fourplex, $560,000 purchase. Rents, $1,200 per unit equals $4,800 per month, 20% down. Conventional loan. Mortgage, $3,200. Sounds great, but 5-year actuals showed 2 vacancies, 2 HVAC replacements, 1. Eviction insurance doubled. Taxes jumped 20%. Average actual cash flow over 5 years. Less than $250 per month. That's $62 per month per door. You could earn more with a high-yield savings account. Finally, my own example. Property C, my first deal, townhouse. Bought for $267,000, 5% down with FHA, HOA fees of $300 per month. All-in monthly cost around $1,800 rent, $2,500. After accounting for vacancy, maintenance, CapEx, and that creeping HOA, I was clearing around $400 to $500 per month for several years. But I didn't do a 1031 exchange when I sold, and I underestimated long-term HOA impact. Still, it was a profitable deal, but it was close. Here's the point. Even when things go right, the margins are thin if you don't know what to watch. So what's the right way to calculate success? I use the cash flow formula. It starts with gross scheduled rent minus 7.5% vacancy minus 10%, maintenance minus CapEx allocation minus property management. Even if self-managed minus actual property taxes and forecasted insurance equals true net operating income. Then subtract debt service to find your actual monthly and annual cash flow. From there, calculate cash on cash return, cap rate, debt coverage ratio, and long-term IRR if you plan to refinance or sell minimum thresholds. I want at least a 10% true cash on cash return, a cap rate 2 to 3 points above current borrowing costs, and a debt coverage ratio over 1.25 minimum, ideally 1.4 plus, and I'll walk away from a great deal if it doesn't meet those numbers. Because the goal isn't just to buy real estate or a job, it's to build financial freedom. If you want to run your own deals the same way, I've got a full rental property analysis checklist linked in the description. It has every line item I use, from underwriting to walkthrough to offer. And if this video helped you avoid a bad deal, do me a favor. Hit that like button, subscribe, and drop a comment. What's the biggest number you forgot to include when analyzing your first property? Let's learn from each other and keep building smarter, one deal at a time.